MGM president and CEO Bill Hornbuckle. Bill, another thing that analysts had said, the analysts at Susquehanna saying that if you buy MGM, you better be right on Las Vegas. What is the promise of Las Vegas in terms of how much you can bring in this year and how booming the economy could get this year?
Look, for us, Las Vegas fundamentally is still the core of our business. We're in the luxury segment, and about 80% of our earnings come out of luxury. So when you think about the place I'm sitting in today, Bellagio, Aria, the Cosmopolitan, MGM, and to a certain extent, even Mandalay in our core convention business, it is all doing well. Occupancies are at all-time high again. Average rate, we reported for the quarter, and I think it'll extend in this quarter up 6-7%. And so Las Vegas continues to do well. I think the question will be not if they come, but what the spend will be around the periphery, around entertainment, food and beverage, and some of the other ancillary things people spend money on here. But our core fundamentals are solid, and Las Vegas is continuing to drive that for us, and I think ultimately for the industry.
Bill, how do you feel about inflation at this point in time? Are there any signs that the consumer is feeling the sting of inflation that could impact that trajectory in Las Vegas or anywhere else in the country?
We're not, immune from any of it. I think at the end of the day, people still cherish this experience. It's a getaway. It's an escape. I'll reflect on something. Back during even the Great Recession, our company ran 82%. So if you think about 2008 and all that happened, that people come to Las Vegas. What they do when they're here, what they spend money on, ultimately, I think becomes that differential, the barometer. We have not seen a slowing down. Somewhat in the lower end of our category, the legacy properties that we have, we've seen some minor pullback, but you saw the results as it relates to the overall totality of our business, driven by this particular quarter Super Bowl here in Las Vegas and other events that we'll continue to host here. We've become not only the entertainment capital of the world, but one of the sports capitals. And so when you think about the entertainment drivers we have between Allegiant, T-Mobile, ultimately and subsequently in a couple of years, the A's coming here, the long-term view is pretty strong.
Well, just to meditate a little bit longer on Las Vegas, I mean, you mentioned the Super Bowl, for example, some of the other sporting events coming up. You have Formula One coming up as well. When you think about those events and the benefit on Las Vegas properties, I mean, how tangible, how meaningful has that been?
Substantively. I mean, if you go back to 19, which was, given the pandemic, was the last real full year we could measure off of, we have absolutely raised the bar when it comes to rooms of note and pricing. And so, we're looking at 25 to 35% more than we were at that baseline. And that has been consistent and continues to be consistent from last year, 23, which was a record year, now into this year. And so we remain very optimistic. And we have now enough of those events. It's not like we have one. We consistently pull them in and continue to motivate that activity. Allegiant Stadium was destined to have about 24 events a year. Last year it had 42. This year it's going to have like 35 or 36. And so they're meaningful. And literally that stadium sits in our backyard, particularly at the south end of the Strip. And so the activity case is consistent, and it's just raised the totality of the bar for all of us, but particularly us here with 9 properties.
Well, let's talk a little bit about your portfolio of casinos, because Bloomberg News has reported that you're considering some of your domestic casinos. And you actually said earlier today that your casinos must show, quote, real growth or risk sale. So if you could define real growth and over what timeline you're thinking about potential sales, that would definitely be helpful.
I think principally it's around our regional properties. And when you think about the marketplace, when you think about real growth over inflation, when you think about capital requirements and where it's best to put our capital, either in, as you've seen, we've bought back 36% of the company over the last couple of years, or in assets that are both international or as well here in Las Vegas to a certain extent. What's the best use of our capital? And so when you think about a couple of our markets, we question, we challenge, is there going to be real growth there? What are the capital requirements coming up? And how are we best and our shareholders best served? And in a couple instances, we probably will do something, but that's time to tell.
When you look at the excess cash that you reported, I believe it's about $1.2 billion, Bill, and it raises the question, would you consider acquisitions at this point, particularly when it comes to expanding in your digital presence, online sports betting?
When you think brick and mortar, I think less so. We are more interested in new jurisdictions that have real growth. We're building in Japan, and that'll take a great deal of our cash over the next couple of years. But when you think about digital, we see that as the horizon. And I know we have a partnership with Entain and BetMGM here domestically, but we've invested a great deal of time, energy, and money, and we'll continue to do so internationally through our Leo Vegas acquisition. We now have a content gaming company that helps us provide content into that business. We're looking for other bolt-ons that would make it make sense. We're very interested in live dealer, a proposition we'd like to motivate here from Las Vegas and broadcast to the rest of the world. We think it could be meaningful over time. And so we're going to continue to invest into that space and relatively aggressively, but realizing those are not massive capital allocations or capital outlays. They're more structurally getting a business right for long-term growth.
And Bill, we don't have much time left, but we haven't even talked about China, and we have to talk about what's going on in Macau, where you recently gained share. I think a lot of people got excited to see those details in the report this morning. What do you attribute that gain to? Is that just the overall pie growing? Of course, that recovery is still going on. Are you actively taking share in that market?
No, I think we're actively taking share. Look, we came into the pandemic with about 8 or 9% of the market. We currently sit in the mid-teens. This last quarter was 17%. We've been aggressive in the context of what we've done to the properties, what we've done to the casino floor and the layout, how we've approached a new era without junket operatives. We've had offices all over the globe, most notably in the Far East, for 30 years. And so our ability to leverage into our own network and our own systems to go get customers directly and understand their wants, needs, and desires, we think is somewhat unique, and it's paying off. And you can see the results. Obviously, we just hit our quarter over $300 million in cash flow, which was an all-time record, and we believe we can sustain this level.